Over to you, Claire.
Thank you. Welcome to CPA Australia's webinar, Independence Issues for SMSF Auditors. My name is Claire Bannon and I'm the Senior Manager of Professional Standards in the Public Practice and Professional Standards Business Unit at CPA Australia. We've people joining us from all over the country for today's webinar. I'd like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. I'd also like to acknowledge that today we are joined by the CPA Australia Board Director, Maren Kelsall, who joins us from Melbourne. Thank you for joining us today, Maren. It is now my pleasure today to introduce Kelly Grant, who's the Director, the Self-Managed Super Funds Approved Auditors Portfolio Superannuation from the Australian Taxation Office. Kelly has been with the ATO since 1997 and worked in a number of areas before joining Super in 2008. She spent several years in Super's complex technical unit, providing advice on a wide range of issues, and has also worked in the SMSF area. Here she spent some time in the trustees' portfolio, determining the appropriate responses to and retreatments for a wide range of SMSF income tax and regulatory risks, as well as managing the early engagement and voluntary disclosure service that trustees and/or their advisors can use to rectify fund breaches. Currently, Kelly is working in the approved auditors portfolio and is involved in identifying and treating risks associated with the sector, as well as creating strategies and guidance to assist auditors with their regulatory obligations. Before I hand over to Kelly to start today's webinar, I'd just like to point out that Kelly will pause at the end of her presentation today to answer any questions that you might have sent through the chat box functionality during the webinar. If we do run out of time and we don't get an opportunity to respond to everyone's questions, Kelly will endeavour to review all unanswered questions following the webinar and will share her responses with you post the webinar. I'll now hand over to Kelly to start the webinar.
Thanks, Claire, for that introduction, and hi everyone. Today I'm going to speak to you about what's been probably one of the most important topics for industry this financial year, being the ATO's compliance approach to auditor independence as a result of the restructured code that became effective on the 1st of January 2020 and the independence guide that was issued in May last year. Now, we're only a couple of days away now from commencing our enforcement action, where we find firms are continuing to carry out in-house audits that contravene the independence standards. So hopefully today's session will be a final opportunity to ensure you're familiar with these rules and ask me any questions you might be unsure about. And as Claire said, if I can't get to your questions at the end of the session, I will take them on notice and send answers to Claire to share with you all after the session. So I'd like to start my session by looking at some of the key documents relevant to SMSF auditor independence. But I won't spend too much time on this though, because hopefully by now you're all well and truly familiar with those. So under the SIS regulations, SMSF auditors must comply with the independence requirements produced by the APSB and set out in the APES 110 Code of Ethics for Professional Accountants. Now, a restructured version of the code was issued over 2 years ago now, on the 2nd November 2018, and as I mentioned before, it became effective on the 1st of January 2020. Now, that was the most comprehensive rewrite of the code that had occurred in the last 2 decades, and the restructured resulted in a new user guide on how to apply the code, a revised glossary with additional explanation of key terms, requirements now denoted in bold type, which establish general and specific obligations with respect to the subject matter addressed. And these requirements should now make it easier for SMSF professionals to implement and easier for regulators like the ATO and ASIC to enforce compliance with the code. There have also been significant refinements to the code to enhance the conceptual framework, which now makes it explicit that in certain circumstances, you either need to disengage or stop the activity. And the audit independence provisions have, of course, been recharacterised as independent standards. And now the code is principles-based, and it sets out a conceptual framework to assist in the application of the fundamental principles. So while the conceptual framework has been enhanced, the core of the code, being the 5 fundamental principles and the 5 threats to, those fundamental principles, remain the same. And the overarching requirement for all members to apply the conceptual framework to comply with the fundamental principles is explained in section 120 of the code. And that particular section is now referred to the beginning of each section of the code. And there is a clear recognition that in some cases you are going to have no safeguards that you can apply to threats. It's also critically important to understand how the conceptual framework works as it flows through the whole code, including to independence, and is its foundation. So there are three main stages to the application of the conceptual framework that all auditors are required to do. And that is, for any engagement, make sure you identify any threats, evaluate those threats, and then address those threats to an acceptable level. And in all those three stages, auditors must also exercise their professional judgment in doing that, remain alert for new information and changes in facts and circumstances, and use the reasonable and informed third-party test. And this could include the ATO or ASIC. So when assessing threats, you should ask yourself, is it likely the same conclusion would be reached by the regulators? So the next document that needs to be considered in relation to SMSF auditor independence is, of course, the Independence Guide. Now, the new 5th edition is a collaboration between APSB and the three accounting bodies. And the previous 4 independence guides were actually developed by only the 3 professional accounting bodies. APSB's involvement in the 5th guide was partly due to the need to ensure alignment with the restructured code. Now, the guide was issued in late May 2020 and incorporates over 50 practical examples for accountants to understand the application of that conceptual framework to audit independence matters. Now, Chapter 4 outlines the conceptual framework of the code. Chapter 5 deals with public interest entities, so not self-managed super funds. Chapter 8 is the all-important chapter for the delegates listening today that contains those SMSF auditor independence examples. So well worth going and having a look at Chapter 8 of the code if you haven't done so already. Now, following the release of the new Independence Guide, the ATO realised that there were some examples in the guide that made it very clear that firms who provide both non-assurance and auditing services were only going to continue to be able to do so in very limited circumstances. So we published an article in June last year alerting industry to the issue, but we soon realised industry was seeking further guidance about our views on certain restructuring arrangements such as audit pooling, outsourcing arrangements and reciprocal auditing arrangements. So this led us to publishing some further guidance in March this year, which now forms part of a dedicated independence webpage for auditors and contains information about general independence requirements, as well as how the code applies to the provision of tax and financial planning advice. And it also discusses the code requirements that impact on in-house audit, such as the management responsibility and routine or mechanical requirements in the SMSF context, but we'll discuss those a little bit further down the track. It also discusses what the ATO expects to see on the auditor's file to demonstrate compliance with the standards and our compliance approach for the 2021 financial year. And you can access that guidance of ours by typing in ato.gov.au/auditor independence in your web browser. Now, firms should use their professional judgment and our guidance material to assess whether their specific arrangements comply with the standards as set out in the code, because we really can't provide certainty about some proposed arrangements in the absence of doing a complete analysis of the facts and circumstances. And we're really only likely to undertake that type of analysis when we go out to your firm and do a compliance review. So when it comes to discussing some of the general audit independence requirements, our guidance lists the main scenarios where an SMSF auditor cannot audit the fund under any circumstances. And this is because the circumstances creating the threats cannot be eliminated and no safeguards can be applied to reduce the threats to an acceptable level. So in some cases, the only way to address the threats is for an auditor to either decline or end the audit engagement, or the engagement for other services that might be creating the threats. So these circumstances are where the auditor is a trustee and or member of the fund, or their spouse, dependent or a business partner is a trustee or member of the fund. Now, around half of our auditor referrals to ASIC each year actually contain an independence issue from either the auditor auditing their own fund, a family member's fund, or a business partner's fund. So we're still seeing a few blatant independence breaches, unfortunately. We also refer a few auditors to ASIC who are sole practitioners and who have staff reporting to them who prepare the fund's accounts, which the auditor then audits, which is also prohibited. Now, if the auditor has a close business relationship with a trustee or member of the fund, they must not audit the fund unless that financial interest is immaterial or the business relationship is insignificant. And finally, the auditor must not audit another auditor's fund if the other auditor is auditing their self-managed super fund. So this is a type of reciprocal arrangement that we think is akin to the auditor auditing a business partner's fund, and there are no safeguards that can be put in place to reduce those threats to an acceptable level. So the auditor should decline the engagement. And we've recently referred 18 auditors to ASIC over the last few months for continuing to engage in those sort of arrangements, despite warning them twice by letters about our concerns with those arrangements. And there are also situations where, although not prohibited by the code, do give rise to independence threats, which the auditor needs to evaluate and use their professional judgment to determine if they are at an acceptable level and then address those threats by taking appropriate action. So example of these types of situations are listed here in this slide, and they include where the auditor audits the fund of a close family member or has a close personal relationship with the trustee of the fund, where the auditor's firm provides non-assurance services such as accounting, financial planning and taxation advice to the fund, where the auditor is also an accountant who prepares the financial statements for clients and enters into a reciprocal arrangement with another accountant who is also an auditor to audit each other's clients. And threats can also, of course, arise where a large portion of fees for multiple audit clients emanate from the one referral source or just a few referral sources, but I'll talk more about that a little bit later. We actually did refer 2 auditors to ASIC last year who were auditing around 1,000 funds each, just from the one referral source. Now, those auditors didn't end up voluntarily deregistering. However, ASIC did agree with our findings that those 2 auditors were clearly breaching the independence standards as the self-interest, intimidation and familiarity threats arising from those arrangements were clearly just not an acceptable level. So yeah, as I said, I'll talk a little bit more about those referral source issues a little bit later on. So the independence rules apply to all approved SMSF auditors, including their auditing firms and network firms who also provide non-assurance services to SMSF audit clients. So non-assurance services are basically those services which aren't auditing services, such as accounting, bookkeeping services, administrative services, valuation services, and tax and financial planning services. And a firm in the code refers to a sole practitioner, partnership, corporation, or other entity of professional accountants, and an entity that controls or is controlled by one of these entities through ownership, management, or other means. Now, a network firm is described in the code as a firm that belongs to a network, being a larger structure that's aimed at cooperation and is clearly aimed at profit or cost sharing or shares common ownership, control or management, common quality control policies and procedures, a common business strategy, the use of a common brand name, or a significant part of professional resources. So, for example, the independence standards apply to a firm that will also belong to a national network of firms with a branch in each state and territory that are aimed at cooperation and share a common brand name. In such cases, an independence threat might therefore arise if an auditor conducts an audit for a self-managed super fund client who's receiving other services for the fund from another firm within the network, even if they are in another state. So whether a particular arrangement constitutes a network of firms within the meaning of the code will ultimately depend on the facts and circumstances. So if you belong to a network, a firm or a network firm that also provides non-assurance services to a client, you should actually be assessing your current auditing engagements against the definitions of a firm and network firm within the code. And you should also read Chapter 6 of the Independence Guide. It provides some really good examples of what constitutes a network firm. Now, before a firm accepts an engagement to provide non-assurance services to an audit client, the firm or network firm must determine whether providing that service does provide an independence threat. So up until the release of the Independence Guide, the 5th edition of the Independence Guide last year, many firms were of the belief that they could perform both audit and non-assurance services as long as they had practices in place to separate those functions or activities, commonly referred to as ethical walls or Chinese walls. For example, they may have had separate teams or divisions in the firm reporting to different partners. Although some non-assurance services can be provided to a self-managed super fund client, for example, routine tax return preparation, in many cases, providing those services will give rise to independence threats, self-interest, self-review, intimidation type threats, and they'll need to be evaluated and addressed. So in-house audits will only be permitted in limited circumstances because of certain requirements in the code that auditors must comply with when providing non-assurance services. And the first requirement, of course, is the management responsibility rule. You guys hopefully will now be familiar with all these rules, but the management responsibility rule is found in paragraph 600.7 of the code, and that says that a firm or network firm shall not assume management responsibility for an audit client. So if a firm or network firm assumes any management responsibility for an SMSF audit client, they just can't audit the fund under any circumstances, even where the preparation of the financial statements for that fund might be routine or mechanical. Now, management responsibilities, there's some examples in the code, and they involve controlling, leading and directing an entity, and they also comprise activities that generally will require the exercise of professional judgment, giving rise to those self-review, self-interest threats when the auditor goes to audit the client. And examples in the code will include setting policies and strategic direction, authorising transactions, controlling or managing bank accounts or investments, and deciding which recommendations of the firm or network firm to implement. And of course, taking responsibility for the preparation and fair presentation of the financial statements. So in the SMSF context, management responsibilities are activities, decisions and judgments that the trustees are ultimately responsible for in their role in managing their fund. So they cover all the decisions and judgments made on behalf of the fund to ensure the trustees comply with their obligations under the super and tax laws. And they include decisions such as ones involved in setting up the fund, decisions around structuring the fund, preparing the fund's trustee, organising how to execute it, and developing and maintaining the fund's investment strategy. They'll also include decisions about making and managing fund investments, just for example, decisions around structuring investments to comply with the investment restrictions, the borrowing rules, the sole purpose test, and non-arm's length income rules. They'll include decisions about accepting contributions and paying benefits, decisions around maximising contribution caps, when to commence a pension, ensuring that transfer balance cap requirements are met, and how to structure the payment of benefits. And finally, they might include decisions about preparing the fund's accounts and financial statements. For example, decisions made when setting up and maintaining data feeds to capture the income from investments, and coding fund transactions, reporting fund assets at market value, and allocating income to member accounts, and then calculating the tax payable by the fund. As many trustees rely on tax professionals such as accountants and administrators to assist them manage their fund and make certain judgments and decisions for them, firms and network firms who provide both auditing and assurance services are likely to find it difficult to comply with the management responsibility rule in practice. So, to avoid assuming a management responsibility, the firm must be satisfied that the trustees make or are capable of making all judgments and decisions that are the proper responsibility of management in connection with those non-assurance services. So in the SMSF context, of course, management refers to the trustees. And this includes ensuring the trustees have suitable skills, knowledge and experience to remain responsible at all times for decisions relating to the fund, and that they understand the objectives, the nature and results of those services, and that they understand their responsibilities and those of the firm in connection with the services, that they oversee the services provided by the firm and evaluate whether they are adequate, and they need to accept responsibility for any consequences or actions that flow from the results of those services. So it's only when a firm has been able to demonstrate that it has not assumed any management responsibility for an SMSF audit client that the routine or mechanical test then becomes relevant. So this requirement, of course, is that a firm or network firm is prohibited from providing accounting or bookkeeping services to an SMSF audit client unless those services are considered to be routine or mechanical, and the firm also addresses any threats that are not acceptable level by putting in place safeguards. Now, accounting and bookkeeping services include the preparation of financial statements and accounting records, the recording of transactions and payroll services. So for accounting and bookkeeping services to be routine or mechanical, it means those services must involve little or no professional judgment by the firm. And the code does include some examples of routine or mechanical services which are particularly relevant to the preparation of financial statements. And the routine or mechanical test does not apply to the provision of other non-assurance services. So even with appropriate safeguards in place, firms may find it hard to substantiate that routine or mechanical test has been met because of the degree of professional judgment they exercise in carrying out the services. The code does contain some examples of accounting and bookkeeping services that are routine or mechanical, and they include things such as posting transactions quoted by the trustees to the general ledger, posting journal entries approved by the trustees to the trial balance, preparing financial statements based on trustee-approved trial balance entries, or preparing related notes based on records approved by the trustee. And the extent of the firm's involvement in the preparation of the fund's financial statements and the level of professional judgment required will be the key in determining whether those services have been routine or mechanical. And whilst it will ultimately depend on the facts of the case, we consider that firms will, as I said, find meeting that routine or mechanical test very difficult in practice, and that's just due to the high level of professional judgment ordinarily involved in carrying out services that are related to the preparation of financial statements for self-managed super funds. I should also point out that automating aspects of accounting services, such as the preparation of financial statements using data feeds, is not of itself sufficient to make those services routine or mechanical. But firms who use data feeds to automate the preparation of financial statements still need to consider the degree of professional judgment that they're exercising in carrying out those services. When establishing and maintaining data feeds, like firms will typically make decisions, for instance, requiring the exercise of professional judgment, which can amount to those management responsibilities they shouldn't be carrying out for an audit client. So, for example, they might include decisions around electing the software for the data feeds and setting up for the trustees, establishing the general ledger and deciding how the transactions are to be captured by the data feeds and coded and classified, checking the data from the feeds used in financial statements and tax calculations is correct, monitoring the data feeds to ensure they're operating correctly, and being accountable for any mistakes in preparing the statements for the data feeds. So where the firm is assuming these management responsibilities for the fund in relation to data feeds, then the firm should not even be providing both accounting and auditing services to the same client, let alone considering whether the service is routine or mechanical or not. So even where the preparation of financial statements is routine or mechanical, the Commissioner and ASIC still require the auditor to use safeguards to reduce the threats to an acceptable level. And examples in the code of those safeguards are using professionals who are not audit team members to perform the accounting service, or using an appropriate reviewer who is not involved in preparing the accounts, review the audit or the accounting service. So for those firms who think they can continue to provide in-house audits after the 1st of July 2021, and I imagine there wouldn't be many of them, we expect to see the following on the auditor's file. Evidence that the auditor was satisfied that the firm did not assume any management responsibilities for the self-managed super fund. We expect to see evidence that the trustee has the relevant skills, experience and knowledge to have taken on that responsibility for the preparation of the financial statements. Such we want to see things like copies of trustee coded transactions which the firm used to post to the general ledger, or trustee approved entries to the trial balance. Auditors can't just rely on signed financial statements by the trustees and signed trustee representation letters to demonstrate that the trustee took on the responsibility for preparation of those financial statements. And when monitoring compliance with this rule, we'll also be checking that the auditor's opinion has been appropriately formed by asking firms to confirm whether they've assumed any management responsibilities for the SMSF when providing the non-assurance services. Now, if the firm claims they haven't assumed any management responsibilities for the SMSF audit client, then we will request evidence that the trustees remained responsible at all times and made all relevant decisions and judgments in managing their fund, and that they had those skills, knowledge and experience to do so. And this might actually lead us to contacting the trustees directly to verify that that management responsibility rule has been complied with. So when it comes to restructuring to comply with the independence standards by the 1st of July, we actually think the best approach to firms to adopt is to either just focus on providing non-assurance services to the client or auditing services. We suspect most firms will choose to retain the provision of non-assurance services for their clients and hopefully look at using a panel of independent auditors to conduct the annual audit. However, we do understand that some firms are going to be reluctant to give up their auditing income and might look to source audit clients from other firms. And in doing so, firms then need to be aware of entering into those reciprocal arrangements, where, as I mentioned before, you've got the two professional accountants who are also approved SMS auditors preparing the accounts for a number of SMSFs and then entering into an arrangement to audit each other's SMSF audit clients. Now, we're concerned about those reciprocal arrangements, as of course they might give rise to independence threats that will need to be evaluated on a case-by-case basis by the auditor and addressed if they are on the acceptable level. Now, of course, those threats will include self-interest threats, which may arise if the auditor is reliant or dependent on the one referral source for all or a large proportion of their fees, as that might inappropriately influence their judgment or behaviour. Intimidation threats might arise if the auditor is deterred from acting objectively because of actual or perceived pressures from that referral source. And familiarity threats may arise due to the close relationship between the auditors, where each auditor may be sympathetic to each other's interests or too accepting of each other's work. Now, where the total fees in respect of multiple audit clients referred from one source represent a large proportion of the total fees of the firm expressing the audit opinion, the self-interest and intimidation threats can arise. So, and that's, as I said, due to the dependence on the source and concerns about losing those clients. And so the firm will need to evaluate the significance of their threats and consider what safeguards may need to be applied in that case. Now, factors relevant in the code in evaluating the significance of the threats here include things, factors such as the operating structure and services offered by the firm, whether the firm is well established or new, the significance of the client or referral source to the firm, both qualitatively and quantitatively. So, for example, if the firm generates most of its income from providing non-assurance services, then the independence threats arising from that firm having one referral source for SMSF auditing income are going to be less significant compared to a firm with one referral source that derives all or most of its income from auditing SMSFs. And independence threats may also be less significant in a new firm that is growing its client base and may only have a few referral sources for SMSF audit clients compared to a well-established firm with the same amount of referral sources. So while the code doesn't explain what is meant by a new firm, we would generally consider a firm that has been in operation for less than 2 years to meet that definition. The code doesn't also specify number of referral sources or set percentage of fees from one or more referral sources or clients required to reduce the independence threats to an acceptable level. And nor does explain what constitutes a large proportion of a firm's total fees. However, for well-established firms that generate most of their income from providing SMSF auditing services, as a guide, we're not likely to consider there to be a fee dependency issue if the fees generated from one referral source are less than 20% of the firm's total fees. So if the fees generated from one referral source are greater than 20% of the firm's total fees, depending on the circumstances, the independence threats may be significant enough to warrant the firm implementing appropriate safeguards to reduce those threats to an acceptable level. So it's ultimately a question of professional judgment for the auditor or firm to determine on a case-by-case basis, having regard to the particular facts. In some cases, a lower or greater threshold may be appropriate when taking into account all those relevant factors I just discussed. So this includes considering, percentage of fees generated from one referral source over a reasonable period of time of at least a few years rather than a point in time, to recognise that the changing or developing the firm's client base and structure takes time. Now, self-interest or intimidation threats will also arise if the fees generated from an SMSF audit client represent a large proportion of the revenue of one partner or office. And factors relevant to evaluating such threats include the significance of the client to the partner or office, and the extent to which compensation of the partner is dependent on the fees generated from that particular audit client. Appropriate safeguards that can be applied to reduce independence threats here to an acceptable level are increasing the firm's referral base to reduce dependency on the referral sources, or having an appropriate reviewer who do not take part in the audit engagement review the work. And we shortly soon too, we will put out some guidance on like how that appropriate reviewer can select certain funds in order to reduce that the independence threats arising from large referral sources to an acceptable level. And additional independence threats may also arise in this situation where either the referral source is a former employee of the auditor, or the auditor also receives referrals from non-audit work from the same referral source. So we're going to continue to scrutinise approved SMSF auditors who do engage in reciprocal arrangements, and a referral to ASIC may result if we consider auditors have failed to identify, evaluate and address those threats to an acceptable level. So it's really important that we see on the audit file that you've turned your mind to that sort of issue, and that you do document that you've considered the threats and how you've addressed them. We're quite concerned about the auditors that don't even turn their minds to those issues when we go and do a compliance review. So in order to make the 20% benchmark for referral fees easier to administer, the ATO requested the APSB insert this into the code. And at the time, the APSB and ASIC approved the inclusion of this new draft rule, which has now been released for public consultation in a fees exposure draft for the code on the 31st of May. Now, the new draft rule at 410.14.1 states that when the total fees in respect of multiple audit clients referred from one source represent more than 20% of the total fees of the engagement partner and office of the firm, or the firm expressing the audit opinions, then the firm shall evaluate the significance of the threat and apply safeguards where necessary to eliminate that threat to an acceptable level. So if anyone now wants to comment on that proposed rule, because I have heard that it could be causing some firms some concerns, please, you've got till the 31st of August to write a submission. And if you go to the APSB website, you can see how you can go about doing that. So audit pooling arrangements. Now, We've had a lot of questions about, whether firms can enter into these as part of restructuring to comply with the independence stance by the 1st of July. And we understand firms might be doing that, in order to try and mitigate revenue loss when restructuring. And they basically involve a group of firms entering into an arrangement to audit each other's self-managed super fund clients. However, depending on how they're structured, the arrangements can give rise to self-interest, familiarity and intimidation threats to independence. And these threats will need to be evaluated and addressed if they're not an acceptable level. So because of the way audit pooling arrangements can be structured and the nature of the relationship between the firms, the arrangements may involve in substance the creation of networks of firms, which could result in further independence issues. The arrangements may also result in reciprocal auditing of SMSF clients. The safeguard of spreading out client referrals to a number of SMSF auditors, which may be applied in other reciprocal arrangements, may not be sufficient or appropriate to reduce the threats to an acceptable level here. And there's also a risk with audit pool arrangements with respect to restructuring. For example, if a firm all of a sudden withdraws from the pool, that might give rise to some additional independence issues all of a sudden for other firms to think about. So even where the arrangement doesn't involve reciprocal auditing, firms within the pool still need to then avoid creating a network of firms within the meaning of the code, as the independence requirements will still apply. So, for example, a network will be created if there is a structure aimed at cooperation that shares a common business strategy. And that could occur, for example, in situations where the firms in the pool have an entity overseeing the arrangement and allocate audits amongst the participants, or there are agreements in place in the terms of which provide that the firms agree to exclusively audit each other's clients on an ongoing basis. So Part 4A of the Code and Chapter 6 of the Independence Guide, they provide additional examples, as I said before, on network firms, including when a network firm is created by a larger structure of firms. So if you think of entering those arrangements, as I said, please read those examples and be mindful of the definitions and whether you're meeting that network firm definition. Now, firms enter for the purpose of trying to determine whether another firm is, or other firms are suitable to audit their SMSF clients, and participation isn't conditional on the firm accepting ongoing referral work from other firms, then the arrangement may not involve the creation of a network within the code. However, firms still need to consider whether independence threats arise in those circumstances. And some audit pooling arrangements we've heard can give rise to partnerships or joint ventures if there is an agreement between the firms in the pool to share revenue, profits or expenses in relation to the arrangement. So if this is the case, there'll be taxation consequences, of course, for you to consider as well. Now, whether a firm engaged in an audit pooling arrangement complies with the independence requirements will, of course, depend on the exact facts and circumstances. However, we do encourage firms to take care when entering into those sorts of arrangements, as they're ultimately responsible for ensuring they comply with the requirements. And that's the case even where the arrangement might be structured through a third-party provider. So going forward, audit pooling arrangements will be subject to extra scrutiny by us just because of the potential threats involved in structuring a group of firms and the risk of non-compliance with standards. We've also had some concerns about the types of outsourcing arrangements we're hearing about. The first involves a firm outsourcing the audit to an auditor who once provided non-assurance services to the audit clients while they're a partner, employee or consultant of that firm. So the auditor still needs to be aware of potential self-review and familiarity threats that may arise in taking on those clients, and that's the case even though the auditor is no longer associated with the firm. These threats might prevent the auditor from appropriately evaluating the results of previous judgments made or advice provided to the clients when the auditor worked at that firm. Now, auditors could look to eliminate these threats by having another auditor in the new firm undertake the audits of previous clients. And where there are no other auditors available, an appropriate reviewer who is not involved in the audit work could review the work. If the time period from when an auditor was a partner of the firm exceeded 2 years, it would generally not create threats to independence. However, this is dependent, as I said, on the particular facts and circumstances of the situation. So the auditor must exercise professional judgment and apply the reasonable and third-party test to determine if there are any threats to independence that still might exist. So the second outsourcing arrangement we're concerned about involves firms engaging other SMSF specialist firms, whether within or outside Australia, to prepare financial statements and conduct audits. So sometimes the specialist firm who will take on the fund administration and accounting services will use an independent auditor to conduct the client's audit, which we don't have an issue with. However, sometimes we see issues where SMSF specialist firm may also conduct the fund's audit or be a separate firm to the firm conducting the audit, but form part of a network with the audit firm within the meaning of the code, for example, because they're firms that are aimed at cooperation and have a common ownership structure. So if the specialist firm conducts the funds audit or the audit firm is a network firm of the specialist firm and or the audit firm still need to comply with the independence requirements of the code. And the fact that the accounting services may be provided by the specialist firm to the outsourcing accountant, who then takes responsibility for the financial statements and not directly to the trustees under the arrangement, doesn't change this. And we consider that the accounting services are still being provided by the specialist firm to the SMSF audit client. So in this situation, the specialist firm can't assume any management responsibility for the trustees in carrying out the service. And the specialist firm can only prepare the financial statements for an SMSF audit client if the services are considered routine or mechanical and the firm addresses any independence threats by applying the appropriate safeguards. Now, whether this type of outsourcing arrangement complies with the independence requirements is a bit like audit pooling arrangements. It'll come down to the particular facts and circumstances of those engagements. And that means, you know, that'll include looking at the individual service agreements between the trustee and their accountant and the accountant and the specialist firm and how the arrangements are implemented in practice. However, really though, we don't think these sort of arrangements are within the spirit of the code, so we will be closely scrutinising these types of arrangements because of those independence threats involved and the significant risk of non-compliance. So during the 2021 financial year, the ATO has taken a transitional compliance approach in relation to the standards that impact in-house audits. Now, this means that we have not enforced compliance with the standards during 2021, but have rather used this financial year to educate auditors on the standards and help them meet their obligations. So auditors have hopefully been using their professional associations, such as the CPA, for further guidance and support in relation to compliance with the code during this time. However, for any audits now completed after the 1st of July 2021, regardless of the income year to which they relate, that do not comply with the standards, we will be looking to enforce compliance with the new requirements. And we may end up referring auditors to ASIC for further action if we deem that necessary. Now, while the ATO has issued guidance this year and has delivered webinars for the professional associations on independence, to further alert auditors to our expectations in relation to compliance with the standards for in-house audits, we've updated our SMSF Independent Auditors Report. Now, the new version of that report must be used for all audits completed after the 1st of July 2021, and it contains a couple of new independence clauses in Part A and Part B of the report. And the clauses will require the auditor to acknowledge that their firm or network firm has not provided any non-assurance services to an audit client that are prohibited under the code, and where their firm or network firm is still preparing financial statements for an audit client after the 1st of July 2021, the auditor will have to acknowledge that a management responsibility had not been assumed for that audit client and that the services provided were routine or mechanical and safeguards had applied. So to enable auditors time to transition to use of the new Independent Auditors Report, we're not going to take any compliance action where auditors continue to use the previous version of the report during the month of July. That's just so auditors have time to get up to speed with the new version. But the old version will be removed from our website by the end of July. Now, you can download a copy of that new SMSF Independent Auditors Report from our website. just go to our homepage at www.ato.gov.au and type in SMSF Independent Auditors Report in the search box. And finally, where firms now find themselves in a position where they think they will not be able to comply with the standards by 1st of July, they should contact us by this date and let us know why this is the case. And they can contact us by emailing ATO SMSF auditor team at ato.gov.au. So, should you wish to locate further information on what I've discussed today, this slide here provides a really handy summary of the APSB, ATO and CPA guidance that is available. So if you haven't already looked at the CPA website, I recommend you do so. The short fact sheet on SMSF auditor independence has a very helpful flowchart which takes you through the various rules impacting in-house audits or the provision of non-assurance services. There's also a document with frequently asked questions and answers in relation to this topic. So highly recommend you look at that as well. So thank you, everyone. That concludes my presentation for today. I hope you found it helpful and by this stage are well and truly on top of those rules in the code that impact in-house audits. And if you have been doing those, have managed to restructure, find alternative means now for your clients that will better service them and make sure you actually comply with the code going forward. And I'd just like to thank the CPA again for the opportunity to provide some more awareness about SMSF audit dependence in general during this session today. So thanks, Claire. I think I'm ready for some questions now if anyone has any.
Kelly, I think you have had a question come through. Let me just have a look. Okay, so we've got one from David and it says, where an auditor of a fund for the year ended the 30th of June 2020 has not met the independence requirements until near the end of the ATO no action position. Do you expect their audit report declaration to be in a form such as, I am independent of the SMSF in accordance with the auditor independence requirements, other than description, e.g. firm's involvement in preparation of financial statements?
Oh, not sure. I'm really not sure what that's asking, Claire. I think I think the delegate that asked that question might be asking me if I've understood this correctly. Can they already start using some of maybe those independence clauses that have found their way into our new version of the independence into our new version of the SMSF auditor independence report? And look, more than happy for you to put those clauses in if you'd like to do that. I mean, the clauses were mainly there going forward because we have let everyone know that we will be looking to take compliance approach from the 1st of July onwards. So they're really optional up until the 1st of July 2021 for any audits completed before that date. I hope that answers the question. If it doesn't answer, was it David's question? Happy, David, for you to send that through and I can consider that question for you a little bit further.
We've had another question, Kelly. I'll just read it out. Will there be a checklist for reviewers in relation to SMSF auditors who have referrals from a source which is over 20%?
Yeah, that's a good question. So, look, not so much a checklist. What we're working on now with the APSB and CAN, CPA and IPA is just some further guidance or further paragraphs to insert into our SMSF auditor guidance that just provides some, I suppose, just general guidance to appropriate reviewers on how they can reduce independence threats arising from a large referral source. And what we've been discussing at the moment is the potential for the appropriate reviewer to select a sample of funds and not every single fund needs to be reviewed in that referral source. And we're looking at probably getting some guidance out that talks about what would you probably expect to see in that sample of funds. It's not a case of every 5th fund or every 10th fund. It's really a case of the type of fund that's being reviewed and whether that particular fund is likely to give rise to some of those independence threats. So, for example, we'd expect to see the more complex funds, requiring a higher level of professional judgment that the auditor needs to exercise in that group, as well as a representative amount of the less complex funds, because they're still going to create independence threats as well. So we won't be coming up with a checklist, but just some general guidance to give appropriate reviewers who we still expect will use their own professional judgment in determining what is an adequate sample size when they go to do those sorts of reviews. But once that guidance does issue, Claire, if any auditors feel it still doesn't meet their needs, by all means, we will look at further elaborating on that issue if we need to. Our guidance, I should say, is very much a moving beast. As further issues come to light, we will further look to update that guidance to make it helpful to industry.
Great, thank you. Thanks for your question, Terence. Are there any more questions? If so, please do pop them into the Q&A box. But that's all I can see at the moment, Kelly.
Okay. That's it. I was going to say, if anyone does have further questions that they haven't thought of now, but they do come to mind and want to ask them by the 1st of July or even after the 1st of July, doesn't have to be by that magic date, please email them to ATO SMSF auditor team at ato.gov.au, and we'll do our best to endeavour to answer those for you.
Wonderful. Thank you, Kelly. Oh, I just see one more question. We might just tackle this one.
Yep.
Network of firms, this is from Lauren. Network of firms, does this include where independent firms operate in association under an international brand or association group?
Oh, I think it does. Look, I don't want to give a definitive answer here, but I'm pretty sure I remember from looking at some of the examples in Chapter 6 of the Code, it does extend to international branches. But Lauren, I might just consult. I might just get back to you on that just to confirm that for sure. I think it does. I think it does.
Thanks, Kelly. So that was Lauren posting on behalf of Tony. So that's wonderful. We'll get back to you, Tony. Thank you. And could you repeat the email address, please, Kelly? We've had a request.
Sorry, yes, it's ATO SMSF auditor team at ato.gov.au. And maybe if you even want to share that with your delegates, Claire, after the session, more than happy for you to do so.
Will do. Thank you. Okay, I don't see any other questions coming through. Thank you. I guess Melissa or Lauren, will hand back to you.
Thank you, Claire and Kelly, and thank you to everyone for your participation. In the next 3 working days, you'll receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback, and it is extremely valuable to CPA Australia to help us deliver better events for you. Thanks again, and we look forward to welcoming you to another CPA Australia webinar soon.
Thank you.
Thanks, Claire. Thanks, everyone.
Bye.